Welcome to the Purposeful Wealth Podcast.
Welcome to the Purposeful Wealth Podcast, and in today's episode we're going to consider the subject of cash rates or interest rates and portfolio returns. As systematic investors, which Wells Gibson as a company is, we seek to continually challenge the process in order to maintain a solution which we feel gives our clients, gives us the best ability to meet our own lifestyle and financial goals, as well as the lifestyle and financial goals of our clients. We understand, as our clients hopefully do, that trying to predict the time and direction of market movements over short time periods is probably a fool's pursuit or a fool's errand. Any change in portfolio structure or investment approach, therefore, must be guided by a change in the evidence, or perhaps a change in our investment goals. Now, the interest rates set by central banks have been rising around much of the world in recent times, and one will have done well to avoid such headlines in the news. In the UK, the base rate set by the Bank of England was around, I think 3 years ago, was just 0.1%, and now it sits at 5.25% at this time of recording this podcast. And this considerable increase, much of which happened in 2022, led to historically low returns on bonds, as bonds fell in price in order to align with the rising market yields. So despite rates not having been at such levels for some time, it's worth saying that this is not uncharted territory. In fact, since 1975, rates have been above the current levels for more than half of the time. For investors with medium to longer term, or for investors with medium to longer term liabilities of 5 to 10 years and beyond, these rate rises and corresponding price falls have significant benefits. And given the structure of our portfolios, the now higher yielding bonds should get through these price falls experienced, and therefore over time be enjoying a higher return. It also opens up other options for savers, in that annuity rates and fixed term instruments now become more viable in some circumstances. However, when it comes to the expected returns on portfolios, the evidence remains the same. At Wells Gibson, we fundamentally believe that risk and return are related, and therefore, if the expected return on cash has risen on the back of interest rate rises, so must the expected return on in other asset classes, such as global equities. In other words, shares. If this did not happen, there would be an opportunity for investors to simply own cash for a period of time before re-entering capital markets. And we can look at historical figures to give an insight into whether there is a relationship between current rates on cash and subsequent portfolio returns. And in fact, the historical data, or these historical figures, reveal that at a given level of starting interest rate, the proportion of times in the subsequent year that the investment portfolio outperformed the starting cash rate. In essence, by looking at this historical data, it helps to answer the question which many investors have, and even this morning we had an investor asking this very question. If I lock up my cash today for the next 12 months, I am guaranteed X%. So why take on the additional risk of investing in a portfolio? And this is a question that has arisen on more than one occasion over the past few months. Well, our research would reveal that between January 1970 and June 2023, the proportion of periods that a 60% equity portfolio outperformed cash in the subsequent year were higher than 50%. There is it also revealed that there is no clear relationship between the level of cash rates and subsequent outcome of portfolio returns relative to cash. And in fact, over all 1 year periods in our sample, the 60% equity portfolio outperformed locked up cash in 2/3 of these observations. The average excess return of the portfolio over cash in the 1 year periods was 4%. And if we extend the holding period of our portfolio to 5 and 10 years, the proportion of outperforming periods rises to over 80%. The other practical implications are worth considering, that locking up cash reduces liquidity and may only be withdrawable outside of the agreed period with a significant penalty. And also, savers with larger sums of cash need to be wise and spread cash across different banking groups so that they remain under the Financial Services Compensation Scheme protection limits. And then, of course, we only need to think about bank failures or recent bank failures in the United States, which demonstrated that, or was certainly a cautious reminder to savers not to naively ignore protection limits. So, in closing, the key message from this podcast is really that risk and return remain inextricably linked. We believe risk and return are always related, and that if you want higher expected returns, you have to expect increased risk. And also, that maybe the key message from this is that more than 50% of subsequent years revealed that a 60% equity portfolio actually outperformed cash in over 50% of these periods, sometimes rising to as close to 75%. So, and as we mentioned there, that over all 1 year periods in our sample, the 60% equity portfolio outperformed locked up cash in 2/3 of these periods. So, interest rates have risen. The baseline has increased for all asset classes. So, if you're an investor with a well-diversified portfolio, my message would be to stick with the program. Thank you for listening to the Purposeful Wealth podcast.